Hey, what's up, everybody? What's going on? Tuesday. Big things. Yes, tonight Trump will give an address to Congress. He's going to talk about big things. It's going to be his first major political speech. And probably going to, who knows, have some impact on the market. You know, the market has been hanging on every word on the upside. Anytime he says something, big things, we get a big rally. So tonight that's happening. But again, substance, we have to see substance. Yesterday, more details of the budget were put out there. 54 billion increase in military spending, and that will be offset with cuts in agencies and foreign aid. So it looks pretty neutral, although the defense sector, that's where you want to be, right? But those stocks are not cheap, man. They are not cheap, and I'm not just talking, nominal price terms. I mean, they are not cheap from a valuation standpoint. I would love to buy some of these stocks, Lockheed, Boeing, Northrop, all of these, but they're not cheap. It's the problem with this market. It's hard to find value. So tonight we will have that. What else? Not a whole lot, really. We see oil coming down. I talked about by the way, I sent out the report yesterday. In there, you will see the breakdown, what I call market composition, the position of participants in the market. Again, we have a record net long position on the part of speculators in crude oil, and we have a lot of the data that shows not just very high inventories. We had that. Remember, we had that last May and last August, and all the zombies they were selling and the stop losers. You got to put a stop in, Mike. You got to put a stop loss. I was buying at 39. I bought at 45, 46. It went down to 39. I got up 52. Got to put a stop loss in, Mike. You got to put a stop loss. But the difference back then was I kept pointing out the demand was strong. Now we have, if you look at refinery inputs, if you look at gasoline demand, if you look at imports, a whole range of things in there that are indicating some softness in demand. Some of it is seasonality, but again, if you look at it normally where it is, we are down year over year. So even with the seasonality, there is weakness in there. There is weakness popping up in there. Weakness. So there's that. But you gotta pay attention to this, because and I read a thing yesterday where it looks like institutional investors, they want to ramp up their participation in oil. This is how they do it, right? This is what I was saying about institutional asset managers in stocks. Now they want to ramp up their investment in oil. I mean, what happened when it was down at 30 and 29 and 26 or 31 even when I called the bottom last January? They didn't want to touch it. But now that it's 54 bucks, we should buy some oil. You see, this is how they think. This is what I've been talking about. And as long as I'm on this subject, let me mention, 680,000 net long. Remember, net long is total longs minus total shorts. I mean, if you just want to look at the longs being held, it's over 1.4 million S&P E-mini futures. But I do the net. You want to take the longs minus the short. Net 680,000 net long of these institutional asset managers in the S&P. I mean, they just keep buying and buying. And okay, admittedly, they've been right up until now. Now, if you look back at their past positions, and if you correlate that with where the market was at the time and what happened following that, it's not a good track record, folks. It is not a good track record. All right? So you have that. I continue to sell rallies in the dollar. That's paying off. I continue to buy gold. A lot of you sending me, you're nervous, you're worried. You got to calm down. You got to calm down. You're nervous, you're worried. You're looking at GDX and the divergence between what is happening in GDX yesterday down 5% and what's happening with gold. You know, and you think that's a savvy thing that, hey, I follow GDX so I can extrapolate that. It doesn't always work that way. All right, if you've taken my courses, you know that one of my big things is I warn against axiomatic thinking. What I call axiomatic thinking. What is that? That is thinking that there is some ironclad rule or relationship that always applies no matter what. Well, let me tell you something, folks. If there were axioms that we could apply to the market, if there were ironclad rules that we knew every single time whenever this happens, the other thing is going to happen, we'd all be gazillionaires in a very short period of time. Avoid axiomatic thinking. Yes, GDX is down. Well, you know something? Gold mining companies are businesses. It's not simply about the price that they can sell their product. It's also about their costs. And as we know, inflation at a 5-year high, costs are rising. Fuel costs, material costs, labor costs. Just because they could sell their product at a higher price doesn't mean their profits are going up. All right, now, gold's going to continue to go up. I happen to think it's a beautiful stealth bull market. Like, nobody wants to be long. And if they're long, they're really, really nervous. Really nervous. They just want to bolt out of there at the slightest little dip. And I get a lot of people, what's going on? What? Got to calm down. Got to calm down. Think Zen. Think Aikido. Go with the flow. Surfing, man. Ride the wave. If it comes back down a little, so what? You can't wait? You can't wait? So what? All right, folks. I'm on top of it. I'm on top of it. All right, I'll see you guys later. Bye-bye.